Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. Last week, we saw a fresh record high on Dalal Street as far as the Nifty is concerned, which now is up about 10.5% year to date for 2025. A painful time for the last 14 years, which has now culminated in a fresh peak as far as Dalal Street is concerned. But all is not well, ladies and gentlemen. The small cap space and the mid cap space continue to lag behind, and this is where the bulk of retail money is invested. Yes, we are looking at a record high as far as the Nifty is concerned, but what the future holds is what Miss Shibani Suri Kurian, Senior Fund Manager and Head of Equity Research at Kotak Mahindra AMC will discuss with us. The fourth largest AMC as far as assets under equity are concerned, and Shibani has spent considerable time with Kotak AMC, about 18 years and counting. Good afternoon to you and a very warm welcome, Shibani. How do you see the world post the third quarter earnings? What were positive surprises? What held you back?
Hi, good afternoon. Always a pleasure to be on your show. So, as you rightly mentioned, 2025 has been a year of consolidation for equity markets in India. As a market on a relative basis, we have underperformed the EM pack. And there have been three key factors which have driven markets this year. One has been the uncertainty around trade and tariff, and that uncertainty continues, and we don't know when that final resolution takes place. The second fact has been that over the last 5 quarters, we've seen earnings actually being fairly muted and low single digit for corporate India. And the third factor has been flows, where FII flows have been negative, even while domestic flows have been strong. Now, in that context, as you rightly asked, the fact that is possibly changing at the margin is the quarterly earnings trajectory and earnings growth for corporate India. Now, of course, this was a muted quarter and results were pretty much in line with estimates. And therefore, the key reading from this quarter has been that the downgrade cycle that we were seeing as far as Nifty EPS for 26 and FY27 are concerned, the downgrade cycle appears to be bottoming out. Now, the other thing to note is that in this quarter, if you look at the Nifty earnings is low single digits. But when you look at a broader market, which is NSE 500, the earnings growth has been stronger, close to mid-teens. So therefore, on a broader basis, market seems to be suggesting that corporate earnings is actually starting to improve, though albeit at a gradual pace into this second half of the year. Now, keeping in mind the way we are positioned at this point in time, our belief is that second half should be better in terms of earnings for FY26 as compared to the first half, on the back of the various policy measures that have been taken so far, which should help in terms of uplifting demand. More importantly, going into FY27, our view is that earnings should likely accelerate to mid-teens. And the good part is that for FY27, it will be more broad-based, with sectors such as banking, financials, auto, some parts of healthcare, capital goods possibly contributing to earnings going into FY27. So in that context, I think the earnings delivery takes center stage for markets from here on.
Okay. Allow me to ask an odd question here. You mentioned that the earnings growth at NSE 500 outstripped that of the Nifty. Yet, this has been a large cap rally by all measure. Not many retail investors hold Bharti, M&M, SBI, iShares in their portfolio. They hold mids and small caps where the bulls haven't even, looked at. So how come this dichotomy at the market, mids and smalls languish despite strong earnings growth, and the rally is actually in blue chips?
Yeah, so if you had to, segregate earnings into large, mid and small, large cap we discussed, and Nifty is a barometer for large cap earnings. Mid caps have actually been delivering fairly robust earnings growth, and the small cap segment has actually seen muted performance as far as earnings is concerned. Now for mid and small caps, the fact to note is that valuations here have not been favorable. Mid caps today are still trading at multiples which are higher than their long term average. The good part of mid caps, as I mentioned, is that earnings support is now coming through. For small caps, however, valuations remain about 30 to 40% premium to their long term averages. And in this segment, earnings growth has been muted. And therefore, the way we are positioned, in terms of risk reward, we are still overweight large caps, slightly underweight to neutral on mid caps. And within mid caps, of course, there are bottom up stock opportunities where earnings growth is strong. And we would still remain cautious as far as small caps are concerned. The second fact that you asked about Nifty 500, here there are a few key sectors that have contributed to the earnings trajectory. So metals, oil and gas, these have been two large segments which have contributed to the Nifty 500 earnings. Exclude them, the YOY earnings looks a little bit more muted. So a high single digit kind of earnings for Nifty 500. So net when you look at risk reward, marry valuations with earnings trajectory, the risk reward for large caps still remain favorable.
Okay, fair point. So it's the valuation that is coming into play. Shibani, before we get deeper into what the broader themes are which Kotak AMC is addressing, there is this global issue which is rankling a lot of fund managers. This unprecedented rise in 10-year Japanese yields, which is moving money from all kinds of asset classes because Japan has traditionally been the financer for all risk on trade. Is this something that can destabilize the Indian equity environment because of yen carry trade?
The good part for Indian equities is that our markets continue to be predominantly domestic driven. So, of course, we are keeping a watch in terms of what's happening globally, including the rise in Japanese yields and the impact that it can have if the carry trade unwinds, and therefore impact in terms of flows into India or out of India. But note that over the last 2 years, or even in fact last 3 years, FIIs have actually been net sellers of Indian equities. A lot of what has happened in Indian equities has been driven by domestic flows. Secondly, from an overall composition perspective, we continue to be predominantly domestic in terms of demand and growth as well. And therefore, I think for Indian markets, it's important to see how the overall domestic economy, after the considerable amount of fiscal as well as monetary push that you have seen, whether the domestic economy in terms of demand starts recovering. Some initial signs are clearly visible during the festive season, and that has to continue over the next few quarters. And as we were discussing, if that translates into earnings growth, today where valuations are, then those valuations start looking reasonable. Remember, if you look at calendar year to date, India has been one of the worst performing markets on a relative basis as compared to the EM pack. And therefore, today India's valuation premia as compared to the emerging market has come down to its long-term average history. And as we said, that if the earnings trajectory picks up, then valuation comfort is clearly on your side.
I understand the broader macro and the other tailwinds are very, very positive for Indian markets. Against this background, let's get into the themes that Kotak AMC is trying to address given the modest green shoots that we see in the third quarter. Now, where is fresh money flowing into? What are you booking profit out of?
So if you look at some of the key themes or sectors where we are positive on, I think one large segment has been financials. Here we believe that if you look at even the last quarter, one of the most notable surprises on the upside was from financials, especially with respect to the net interest margins for banks, where the expectation was that margins should decline. However, margins held up pretty well. If you look at macro data on credit growth appears to be improving at the margin, and even commentary from management seems to suggest that retail loan growth is possibly seeing an uptick. Now, growth picking up combined with margin stability or even margin improving towards the second half of the year, assuming that there are no significant policy rate cuts, then the earnings trajectory, which has been weak for the banking sector, should improve going into FY27. Now, this is one sector. If you look at valuations today as compared to their last 10-year history, valuations are fairly reasonable and in line with historic average multiples. And with earnings growth picking up, this is one segment where we are positive on. The second larger theme has been consumers, especially the consumer discretionary space, which includes autos, and that clearly is an outcome of the fiscal policy measures that have been taken, as well as the 100 basis points of rate cuts. The third theme that we have been positive on has been healthcare, especially the hospitals piece. This we believe is a structural theme where incrementally as per capita income grows, the demand for quality healthcare continues to rise. We've seen significant amount of brownfield capex and capacity additions by the hospitals in India, and therefore growth is possibly likely to remain strong. So from our perspective, these are the three key themes that we are, looking at going into FY27.
Okay. And within all these three sectors that you mentioned, you are sticking to large caps.
No, so it's a mix of large caps as well as bottom up opportunities within mid caps. So, as I said, from an overall portfolio construct, the risk reward for large caps appears to be far more favorable. But within mid caps, there have been pockets where earnings growth has been strong. Our investment philosophy, whether it be large or mid, has been growth but at a reasonable price. And therefore, if there are bottom up opportunities within mid caps where we are seeing improvement in terms of earnings growth, married with higher return ratio profile, but where today valuations have either corrected or are reasonable in context of their history, we will look at those bottom up opportunities as well.
Okay. That's fairly well explained. I also see a lot of addition that's happened in the Kotak AMC portfolio on the equity side in capital market stocks. Be it, let's not take names, but be it, back-end services providers in the DMAT space or, some brokers, some AMCs. What's the broader thought process behind the capital market space?
So one, we do believe that the runway for growth on terms of capital markets in India, the runway for growth is considerable. Today, if you look at the penetration or holding in terms of equities in the asset allocation bucket of most investors in India, it's still a fairly small portion. And therefore, this we believe is a structural opportunity. Within that, one of the best segments to be in, which captures the growth opportunity for capital markets in India, has been the asset management space. Now, if you look at the asset management space, a couple of things to note here. One, there has been, while the number of asset managers have increased in India, but there is a fair degree of consolidation in terms of market share where the top 5 or the top 10 are concerned. The second fact is that there is also considerable amount of focus in terms of driving profitable growth, and that is reflected, of course, in the return ratio profile as well as earnings growth trajectory, and it is, of course, a direct play as far as the markets go. We believe that today the way India is poised in terms of as we were discussing, in terms of the proportion of equity in the asset allocation of investors, we believe that there is room for growth, and therefore asset managers become the obvious way to play some of these themes as far as capital markets are concerned. Of course, we have to keep a watch in terms of what's happening on the regulation front in the near term, but on a structural basis, this is a segment that we continue to remain positive on.
And this brings to my favorite needling point with you, that Kotak Bank is the lone institution that has got none of its subsidiaries listed in the capital market space. All of them, as far as rivals are concerned, are listed, but that's a topic for a very different kind of discussion.
Unfortunately, we can't talk about specific stocks, so yes.
I know. We'll discuss this in person once in a while. Okay. Now, what's your gut feel on the broader IT space, which is the frontline service providers? Valuation-wise, they're doing extremely well. Buybacks have added some kind of rigor and strength to where they are in terms of the stock price. Is this a valuation matrix that interests Kotak AMC, or is there more bad form still expected from the frontline tech companies?
So, the way we've obviously this has been a sector which has seen significant amount of underperformance this year. It's been also a sector that has been at the losing end of the entire AI trade, and we'll come to that debate shortly. But however, from our perspective, in a seamless fashion, for you to be actually using AI for productive gain. And that's where Indian IT services really comes in. And therefore, we believe that the overall opportunity set for Indian IT services likely to expand as AI adoption increases. The second fact is that when you look at IT services, deal wins have been fairly strong. However, the conversion of deals to revenue has been lagging, and that is reflected in terms of muted both top line as well as earnings growth for the sector. However, as macro uncertainty ends or at least starts to abate at the margin, some of the deal conversions pick up place. That means revenue growth should start to accelerate from here on. Now, in the near term, of course, remember that second half of the year is a seasonally weak quarter for IT services, and therefore there will be your usual furloughs, etc., which means that Q3 as compared to the first half of the year could see that impact coming through. So that is something that we need to be prepared for. But going into next year, we do see acceleration as far as revenue growth profile is concerned, and in pockets, valuations are fairly reasonable, and therefore, from a slightly medium perspective or a longer term perspective, this is a sector that is clearly on our radar.
Shibani, I think this question also deserves a lot of thought, is whether the global AI trade has now, run its course. As a gut feel, how do you see, top FANG companies now raising debt to fund data centers when there is no revenue stream that is coming in? How does it feel when OpenAI looks for government support to fund its very ambitious, plan? Are these hurdles that are coming in front of you? Are these, signs that the worst is now ahead of us?
So, one fact is that AI as a technology is here to stay. So, AI is a transformative technology. And as we were discussing earlier, a lot of the AI adoption has been at the consumer level or at an individual level and not so much at an enterprise level. And therefore, enterprise adoption of AI will accelerate, in my view. And therefore, AI as a technology shift, which is a major technology shift, is here to stay. Now, the question comes in terms of the amount of capex that has been outlined from here to say 2030 in terms of data center capacities, moving architecture to the cloud and all of that. Now, that's where the entire debate comes as to how this gets funded and whether there is any kind of circularity in terms of the demand that has been spoken about. I think what really boils down is finally all of the capex that you're doing today culminating into an ROI on that capex. And until and unless that ROI or return on investment on that capex is visible, this debate will possibly go on. It's difficult to say whether it's a bubble or not and when that bubble, if at all, busts. But these are some things that will clearly take center stage. However, remember, for a lot of these companies globally, earnings growth has remained strong. The question is in terms of the cash flows and their ability to fund the capex that they are talking about. So I don't have a clear-cut answer as to which side of the debate I am in, but this is certainly something that we will keep a close watch on because finally it does have an impact globally. Luckily for us, we as an IT industry, we are typically a services sector. So the demand for services as far as technology is concerned is unlikely to go away. And as we were discussing, from here on, growth should start to improve at the margin for IT services as far as India is concerned, especially going into FY27.
Okay, so that's the silver lining that we are looking at as far as the frontline tech is in India. My final question to you, Shibani, 1 year from now, where will the Nifty and Sensex be?
So we don't give out a formal Sensex or a Nifty target. But as we were discussing today, when you look at valuations for India, both for Nifty trades in line with its historic average multiples, and on a relative basis to emerging markets, our valuations have clearly corrected. So therefore, the key variable to watch out for our markets will be earnings delivery. And if you'll go by projections and even consensus estimates, the earnings delivery should improve going into second half as well as into FY27, where earnings becomes broad-based across sectors. And therefore, if the earnings starts to play out, multiples from a valuation perspective on terms of 1 year forward or 2 year forward multiples are fairly reasonable at this point in time.
With that hope and the fact that we haven't done much as far as the markets are concerned over the last 14 months or so, let's pray for the best and hope that the Santa rally that begins on Dalal Street goes all the way till the budget. With these thoughts, Shibani, thank you for your time. As always, it's such a pleasure. I don't know where time goes, but we look forward to the next conversation.
Thank you so much. Thank you for having me on your show.
That, ladies and gentlemen, was Shibani Suri Kurian, Senior Fund Manager and Head of Research at Kotak AMC. Please continue watching Business Today television. There's a lot of interesting things happening on the final day of the F&O expiry. More follows after this break.
वही बनाएंगे, उसको कौन रोकेगा? हमारे रामलला